Have you ever looked at the stock market and felt like you're trying to compare apples and oranges? I mean, you see one stock trading at 50 bucks, another one at 500. How in the world are you supposed to know which one is actually the better performer? Well, today we're going to solve that exact problem. We're breaking down a super important tool every investor should know: price normalization.
So let's just jump right in with a little thought experiment. Picture two stocks. One is trading at $180, the other is at $450. Now, over the course of one day, they both go up by exactly $10. So, which one did better? The gut reaction for a lot of people is to say, hey, they're equal, right? Well, that's a classic trap, and we're about to show you why.
And here is the big reveal. While that $10 move was identical, the percentage gain tells the real story. For that $180 stock, a $10 gain is actually a massive 5.56% increase. But for the more expensive $450 stock, that same 10 bucks is only a 2.22% bump. All of a sudden, that cheaper stock is the hands-down winner, isn't it?
And this gets us right to the heart of our first major topic today, the price comparison problem. It's a really common mistake, and you'd be surprised how many people it trips up, not just beginners, but even experienced folks.
Here's the key thing to remember. A stock sticker price, that raw dollar value, tells you almost nothing about its performance compared to something else. Thinking a $20 stock is cheaper or a better deal than a $200 stock is just a fundamental error. What we need is a way to get them on the same playing field so we can make a fair comparison.
And that, of course, brings us to the solution. This is the simple but really powerful technique that creates that level playing field we're looking for. It's called normalization, and it's the key to making true apples-to-apples comparisons in the market.
So, what even is price normalization? Well, at its core, it's just a fancy way of saying we're going to transform all the price data to a common scale. So instead of one stock starting at 180 and another at 450, imagine if we could just press a button and make them both start at the exact same value. Like, say, 100. And that's really the big idea right there. We just pretend that every single asset starts at an imaginary value of 100 on day one. From that point forward, any movement is just a simple percentage change. A stock moves from our fake value of 100 to 105, that's a 5% gain. Easy. It doesn't matter one bit if the original price was $50 or $500. It's that simple.
And you know what? The formula to do this is incredibly simple. All you do is you take the current price, you divide it by whatever your starting price was. We call that the base price. And then you just multiply the whole thing by 100. That's it. The number you get tells you the exact percentage growth from your starting point.
Okay, theory is great, but let's see what happens when we actually put this tool to work with a real-world example, because this is where the light bulb really goes on. All right, have a look at this. We've got three really popular ETFs here: SPY, QQQ, and IWM, over a 20-day period. Their starting prices are, well, they're all over the map: 450, 375, 195. Just by looking at these raw numbers, can you tell me right away which one performed the best? It's a total mess, right? It's almost impossible to see clearly. But now, what happens if we apply that simple little formula we just talked about to all three of these, using day zero as our starting line for everyone? And boom, look at that. Instant clarity. They all start at a clean 100. And by day 20, the results are crystal clear. You can see right away that QQQ was the winner. It finished at 106.40, which means it had a 6.4% gain. SPY was right behind it with a 6.28% gain, and IWM came in at 5.69%. All that confusion from the last slide, it's just gone. The outperformer is obvious. So you can see this is way more than just a neat little math trick. Once you get this down, you unlock a whole new level of looking at the market. You can finally do real relative strength analysis, comparing a stock to its industry. You can spot which sectors are leading the market, or even build some pretty sophisticated trading models. Think of it as a fundamental building block for way smarter investing. Now, while indexing everything to 100 is your go-to, your Swiss Army knife for performance comparison, it's not the only tool out there. For different jobs, analysts use different tools. For instance, they might use something called a Z-score to see if a price has moved too far away from its average, or min-max scaling, which is really useful for machine learning models. They all solve the same basic problem of comparison, just in different ways. Okay, so before you run off and start normalizing everything, there are a couple of super simple but absolutely critical rules you've got to follow to make sure you're always making a fair comparison. And here they are, the two big ones. Rule number one, you're always comparing the normalized prices.
Never, ever the raw dollar prices again. And rule number 2, and this one is non-negotiable, you must use the exact same starting date for everything you're comparing. Trying to compare a stock's performance since January against another one's performance since March, it's totally meaningless. Same start date, always.
So let's do a super quick recap of what we've learned. Number 1, normalization lets you finally compare apples and oranges. Number 2, the index to 100 method is your best friend for quickly seeing performance. Number 3, always, and I mean always, use the same start date for a true comparison. And number 4, once you master this, you unlock much more powerful ways to analyze the market.
So there you have it. You now have the tool to see which asset is really doing better, and you don't have to worry about its price tag. But remember, performance is only one side of the coin. And that leads us to the next really big question. Okay, you can compare performance, but how do you measure the risk you had to take to get that performance? Well, that's a story for next time. Thanks for joining this explainer.